Thank you, Gladys, and good morning to everyone. So it's really a happy moment, I think, for me and also our team at FSM to see live audience, because it's our first hybrid with live audience and virtual audience attending FSM ETFestival 2022. So as my colleague Dejun mentioned just now, the last time we had our physical event with our FSM investors was back in January 2020. So almost 2.5 years of not being able to interact face to face. So gives me great pleasure to have all of you here in the live audience, but also of course virtually, where a lot of our investors are also watching us. So we come together at a time when global markets are being shaken. And as one of our clients mentioned to me this morning, his portfolio is in the red. I told him he's not alone. Of course, that's not of any comfort to him. But hopefully today, after the various segments, the various presentations from iFAST analysts and also our partners from the various fund houses, there will be useful insights that you could all take away from today's event. So as Gladys mentioned just now, I have with me Wing Kwong from Nikko Asset Management in the panel. I also have Dejun from iFAST research team. And I also have Clara, who is joining us via Zoom. Clara is from JP Morgan Asset Management. So Clara, good to see you as well via Zoom. So it's a really hybrid format, live and also Zoom. So what I'll do, I'll just run through a few points in our panel discussion first. So a backdrop firstly of how markets have performed. So as I mentioned just now, markets are in the red. Probably some of our portfolios are also in the red. And I think it's not a surprise. We see global markets, especially on this slide, we have the equity markets, mostly down year to date as of 10th of May. And in fact, I think the only couple of positive markets include our home market, Singapore, which has stood out so far this year. But I think the last few days also has corrected. There's been some downturns. But you can look at this slide and you'll go away with basically a conclusion that, it's been a tough year for markets because of the various concerns that Dejun has mentioned. And I just wanted to bring up this next point because I think one of the key concerns that has roiled markets and investors for the last few months has been inflation. So I think this chart that Dejun used just now basically is a good summary of what that means. The prices of goods and services has shot up considerably in various markets, including the US economy. Home as well, in Singapore, we've had that problem. I think the only very few exceptions to this trend includes the likes of China. So I think we'll talk about China quite a bit later. It gives them a bit more room in that sense to expand monetary policy in terms of how to grow their economy. And of course, what the Fed has done recently with its interest rate hike, especially the one in May, earlier this month, right? So that was 50 basis points. So that's like the largest rate hike they've done since 22 years ago. So it shows that they need to aggressively target inflation. They're worried about inflation because long-term inflation is not good for the economy. And my question here to my panelists, very first question is really, US Fed Chair Jerome Powell last year was still saying that inflation will be transitory. I think that has proven to be a wrong statement. In hindsight, of course, easy to say, but I think they're trying to be more aggressive. So my question to the panelists, and I'll start with Wing Kwong. So what is the right policy to ensure you can tame inflation on the one hand, and at the same time, right, while you increase interest rates, you also don't want the economy to slow down too much. You don't want a recession. So you don't want a situation of stagflation in the economy. So what is your view on whether the Fed will now get it right this time around and going forward? So Wing Kwong.
The Fed has a very difficult job because with inflation so sky high and there's a lot of political pressure for them to bring inflation down. This year is a very politically sensitive year in the US, not just in China. And my biggest worry is that the Fed might find themselves tightening in a slowing environment. If you look at leading indicators in the US right now, for example, the ISM, it is still above 50. It is in an expansionary territory, but we are already seeing ISM numbers coming down to especially important sub-index, ISM index like new orders and inventory build-up. And we are also seeing early signs of this demand destruction among the consumers. One bright spot at what Dejin said just now is really the US consumers has been doing fantastically well. In 2020, there was a huge fiscal transfer from the US government to US consumers through paychecks, to direct cash injection for them to spend. That is normal. And wage inflation is still very high. Unemployment is very low. So that allows the US consumer to continue to spend and even rotating their spending from manufacturing to services, like what Dejin has mentioned just now. But the risk is really that with inflation so sky high, we are seeing early signs of the housing market in the US slowing down. And also, you will look at the consumer sentiment, like the University of Michigan's Consumer Sentiment Index that was last released yesterday. We are seeing continuous deep slowdown in consumer sentiment. It has not really shown up that much in terms of the headline numbers yet. But my concern is whether we will start to see demand destructions leading to lower consumption growth, or not even negative. I don't think that is negative, but low consumption growth. If you look at the US economy leading indicators like now, the risk is really for a softening of the US economy. I don't think we are there yet to say that we are outright recession, but it will make the Fed's job more difficult in aggressively hiking interest rate to tame down recession as the US economy slows down.
It's a tough balancing act. You don't want to slow down the economy too much. But there were some indications from, I guess, the US Fed that they could expect the economy to somehow have to slow down. So it's the extent of, I guess, the slowdown. So whether that leads to a recession and whether it's short-term or whether it's prolonged. So maybe I'll invite Clara at this point to join us. So good morning, Clara. Good to see you. Do you agree as well with what Wing Kong just shared? And what is your view on the Fed's policies, whether they're going to get it right, and what is right in this instance?
Yeah. First of all, can you hear me well?
Can hear you very well.
Okay, perfect. So I do think that, I agree that it's a very tough question to answer. And honestly, I don't think the Fed themselves actually know what the right policy is to, actually kill off inflation just enough, but not, kill the economy at the same time. But I think, what is apparent to me, at least from the last discussion at the FOMC meeting where, Chair Powell actually ruled out the 75 basis points rate hike, is because they do see that the nature of the inflation at the moment is a little bit different than what we're seeing in the past, right? Because I know there's been a lot of headlines about how services inflation is picking up, but if you do take a little bit of a closer look at the 8.3% headline number, a lot of it still comes from the more transitory components that are linked to the reopening. So think about things like your hotel prices, like your airline fares, like used car prices, energy prices as well. So, these are things that are not very easily fixed just by raising interest rates, right? So I think what the Fed doesn't really want to do is to start off by being so overly aggressive at the early stages and then end up engineering a recession or something like a hard landing to actually kill off inflation, because like what you had already pointed out, there are some other forces at play that are already slowing the current US economy. So think higher mortgage rates slowing the housing market, and then you have also fading fiscal stimulus, and at the same time you have a US dollar that's extremely strong. So this shows that the Fed is, being very thoughtful about, the fact that monetary policy has often operates at a very large lag, which makes it difficult to actually gauge what higher rates mean for the economy at this point in time. So my personal view is that the Fed actually has a very decent shot at getting this right, just because of the starting point of the US economy. And I think many of you have already pointed out, and in the presentation today, it was covered very well, that the US economy is continuing to emerge from this global pandemic. And while we could see demand from goods, for goods actually shift to demand for services, the US consumer actually still remains very strong, and corporations are in very, very good shape as of today. So, the strength of the labor market that we're seeing, yes, it might lead to some wage growth that is, not great for inflation, but, at the same time, I think it is a double-edged sword, right? Because this wage growth is exactly the reason why the US consumer is so strong, because they have built up $2.5 trillion of excess savings during the pandemic. And, even with the energy prices that we're seeing today, it's estimated that it can only drag excess savings by about close to $20 billion. So you still have, a large amount of excess that the consumers are able to work with to get through this environment until inflation starts to moderate in the second half of this year.
Yeah, Clara, the point that you brought up about the US households still being very robust in terms of their balance sheets. I mean, Dachin had this slide on consumers' finances in the US. Still very strong. As you can see, the last few months, right, that trend, the lines are going up in terms of their net worth, the money that they have. So partly because of wages, and maybe because of US market rally in the last couple of years as well, before the volatility in the US markets in more recent times. I just wanted to bring up this point because we talked about US economy, but I think we can't escape the discussion on the US market and its influence on everywhere else in the world. Because the last 2 years have been about investors making so much money. I hope it happened for all of you here as well. But we've heard about investors, very young investors as well, getting started, finding it easy to trade, and a lot of their trades have gone to the US stock markets. So the question is really, what's the outlook for the US stock market at this point? Because we've seen how badly whacked it has so far this year, right? And what's the outlook for, let's say, the remainder of the year? So I'll bring in Terjun in terms of the equity performance for US. What's your view?
Right, thanks, JP. I think the outlook for the US, I think my personal view is that equities, they are definitely not going to have the same kind of performance as they did in 2021. US equities is clouded by a number of issues, such as the Russia-Ukraine crisis and also the lockdowns in China. And some of these things are really out of control of the Fed, so they can't really do much about it. And on top of that, the financial conditions in the US are also starting to tighten, and that will weigh on business sentiment. And moreover, if inflation doesn't come down, then I think businesses, they will start to see margins come down, and they will start to take a hit from margins, and that will ultimately lead to lower earnings growth for US equities. So ultimately, I think for the first half of the year, US equities, the share prices have actually come down, but I don't think that they are extremely attractive at this point in time, because just because how highly valued they were to begin with. And on top of that, like I mentioned, earnings growth is likely to see some form of downwards re-rating due to the factors that I mentioned earlier. So valuations, my personal view is that they are probably not extremely cheap at this point in time.
And I guess related to this point, you're probably finding better opportunities elsewhere. I think you mentioned China just now, right? So probably talk a bit more about that on the next couple of slides. But I'll bring in Wing Kwong. So do you also agree, Wing Kwong, with the Terjun's assessment on the US market?
It is a very difficult because right now the market is so volatile and there's so much policy uncertainty. So the way we think about it is we think in terms of different scenarios and different time horizon. The bull case, the bull scenarios, S&P has dropped by almost 15% this calendar year. The bull case is if we achieve a beautiful soft landing, as what the Fed envisaged, I can easily see S&P retracing most of the losses within this year. And any zero COVID adjustment from China will be an added bonus. So that is a huge bull case. But my base case is that we will continue to see a bit more downside weakness, potentially even 5% or even 10% downside for this calendar year. So my base case is rather similar to what Jin. There's a combination of how, but Fed will adjust along the way. They are also looking at how the economy and inflation and wage numbers, employment situation pans out. And we also have to remember that a lot of the problems the US market is facing is not just about Fed policy, but also the geopolitical uncertainty in Ukraine, the energy crisis, and also the inflation, imported inflation. Not everything is within the control of the Fed. So the base case is we probably see a bit more downside, 5 to 10% for this year. But if you have a longer time horizon, right now S&P is trading about 20 times PE, which has come down quite a bit. If you were to look beyond the 1 or 2 years, you're looking at S&P trading at 16 times, which is a really reasonable entry level if you were to start going in bit by bit. And my team has come into what this year, from Thanksgiving last year, which was about end November, we have been increasing our underweight of equities to almost like 10%. No, my team will have been buying US equities now. It's going to slowly go back into the market, re-engage the market. But the bad case, which is not my central scenario, obviously, is you could potentially see another huge drop if the Fed is unable to tame down inflation, and if the US consumer is so worried and that they will stop spending. But that is quite an unlikely event for me at the moment. So right now, my advice is, not my advice, but my view is that the base case is just be nimble. If you have a longer time horizon, when it falls, it's a good time to go in if you have a longer time horizon, like 2 or 3 years out.
Yeah, thanks, Wen Kuang. And Clara, I'll invite you as well to comment on the outlook for the US market going forward.
Sure. So I agree with a lot of the points from the other panelists. And, I think one thing I would say is that we can also employ the same level of flexibility as we do, to different equity regions as to different equity sectors or styles. So I would say, we do continue to like US equities as the earnings outlook still remains relatively strong. So the last time I checked, despite whatever that has gone on in the markets thus far, excuse me, the earnings outlook for US is still, north of 10% for 2022 as well as 2023. And it was actually pretty surprising to me that, actually analysts haven't really downgraded like the earnings outlook at all. In fact, the cumulative year-to-date revisions remain quite positive, about 2% or so, which is in stark contrast to what we've seen in other places like Asia, Japan, for example. And overall, I think we do need to realize that the US is still a market with stronger fundamental metrics. Right, even though valuations are not cheap, you are paying for that higher quality earnings stream there. And the fact that it's derated to around 15-year historical averages, I think is a good time to consider to start to leg in back to US equities, as we do still continue to think that the growth environment is quite strong there. And within the US, I do think that in this environment, we still have a slight preference for value versus growth, because the positive earnings growth outlook is actually very much driven by cyclical sectors still, like energy, industrials, consumer discretionary. Tech is something that comes up a lot. It's still quite expensive even after the sell-off, but there will come a time as we progress through this cycle and enter more of like a later stage cycle where tech as well as growth exposures will become more attractive again, just because as the macroeconomic outlook becomes more lackluster, then people or investors will start to search for more growth opportunities, and typically they will tend to gravitate towards tech because tech continues to be a beneficiary of secular themes. So think digitalization of businesses that has a very strong long-term potential for relative growth versus the market. So yeah, that's my 2 cents on US equities.
Yep. Thanks, Clara. Very good insights from on this point, I think. We'll talk a bit more about, I guess, asset allocation as well. So US and other markets and other sectors in our portfolios later on. So I'll move on to the next point, which is on the war, the Russia-Ukraine war. So I think it's coming to close to 3 months old. And that has, of course, led to a number of disruptions, whether it's on the supply side, commodities prices especially, because both Ukraine and Russia are major producers of a certain amount of commodities as well as energy. So the question here is, what does this mean for us investors? Should we, expect the commodities prices will continue to shoot up? And should we then consider inflation hedging ideas in our portfolios? And if yes, what are some examples of those ideas? Wing Kwong?
I think inflation, my team's view is that inflation will stay elevated for quite a while. Not at 8-9%, but most probably at 3-4%. That is still very high compared to what we have experienced in the last 20-30 years, since 1970s. It is not just because of Ukraine-Russia war. There's also a huge underinvestment in a lot of the commodity industry, in energy and material and mining industries. And now we're also faced with huge demand in commodities coming from the green transitions. And this green transitions is a multi-year, maybe more than 10, 20-year runway to go. So on the demand side, I really see a lot of demand for commodities. On the supply side, there's not been huge investment. So the case for commodities is a good one. And so all of us should start thinking about how do we inflation hedge your portfolio. There are at least 2 ways. The first is buy into things that is exposed to the commodity complexes. This could be in oil companies, in even countries that is net commodity exporter. It is no surprise that, like what Yun said, Indonesia is one of the best performing countries this year. And the other thing that is worth considering in part of this inflation hedge is really buying to stocks of companies that have huge pricing power, that can pass through this inflationary to their end customers. And so it is really worth thinking about building up a portfolio of good quality companies that can do that.
Yeah, thank you. And Clara, would you have similar ideas as well?
Yeah, so I think there are a lot of confounding forces that are impacting commodity prices. So on one hand, you have the Russia-Ukraine war and the supply chain disruptions that's really causing elevated commodity prices. But on the other hand, we also have to think about what's happening in China right now. There's waning Chinese demand due to the lockdowns, as well as some growth fears that are seeping into the market. And there's also a slowing US economy is another one, right? But I think, yes, overall, I agree that, commodity prices should remain relatively elevated. But do I think that it will go a lot higher from here? The answer is no. But typically, if you do have an environment that is slightly more inflationary, commodities tend to do relatively well in those types of environment. And, actually, equities have also historically delivered on its role as a pretty good inflation hedge over the longer term, obviously, and when inflation is not as volatile. But I think another interesting asset class that I wanted to highlight to investors is also alternatives, right? So I'll think about alternative assets like transportation, like real estate assets, infrastructure. So all of these, can really help to, generate income in the portfolio as well as to help to hedge against inflation. Because if you look at private real estate investments, typically they do have a clause in the rental contracts that's tied to CPI. So it's linked to how what inflation is currently doing in the economy. So in a sense, the rental income that you're receiving is kind of protected against the rate of inflation in the economy at the moment as well. So I do think that these opportunities in the alternative space can help to provide some kind of exposure to some unique growth opportunities, as well as a form of diversification, as well as an inflation hedge for investors.
Yep. Thank you, Clara. And I'll move to the next topic, which is China. So Terjun just now, he shared this slide as well, as one of the supporting factors as well to show how the valuations of the China market have turned pretty attractive. But of course, for China, I think most of us, or at least for myself, I have some exposure to China equities and even fixed income. And it's been an interesting, I guess, market because it's done so poorly the last few months. And you have to balance on the one hand that there's, that the competition and that geopolitical risk between US and China. And, there's even been news that Chinese regulators have met with banks on how to protect assets in case there are US sanctions. So I guess in the wake of what's happened with Russia. And you also have, of course, the negative news, disruptions on supply chain and so on because of, their severe, very strict zero COVID policy. But on the other hand, and I think Terjun mentioned that, the crackdowns are possibly, coming to the tail end of it, and delisting risks are also subsiding. And of course, I mentioned just now, inflation risk in China is actually in a very unique situation. It's not like the US. Prices haven't really skyrocketed in China. And what that means, of course, is Chinese authorities have the possibility of playing with monetary policy, expanding fiscal policy to boost the economy, right? So those are good things. How do you balance those two, situations, Wing Kong, for you?
I think the biggest catalyst I'm looking for in China is really their adjustment away from their zero COVID policy. My fear is that no amount of fiscal easing or monetary easing will boost the economy unless you allow the normal economic activities to carry on. And one thing that is really hampering normal economy activities from carrying on is really the zero COVID policy. So on the margin, we definitely see a lot of potential for the Chinese government to ease monetary policy and do fiscal priming, especially infrastructure investing, like what we were told. But I think the number one catalyst I'm looking for is really they are stepping away from the very strict zero COVID policy and allowing normal economic activities to carry on. Within the China space, we find local assets, local RMB denominated assets to be really interesting. And for example, we have a basket of local consumptions that we are building up right now because they're really very low valuation. So rather than overweighting China tech, and right now actually investing a bit more in China consumption story. Not for now, but in preparation for an adjustment on COVID policy that will have to come. It's just a matter of when. Local Chinese government sovereign bond is also something interesting to do because on the margin, we do expect the Chinese government to be more fiscal and monetarily more supportive. But the risk there is really whether we will see any weakening in renminbi. Renminbi has been extremely strong in the past few years, 2 years, until the recent few months. So there's the risk there. So we are not in a stage whereby I'm moving hugely into Chinese assets at the moment, but we do start to look into it, especially a local Chinese consumption story, which has been we have slowed down because of COVID situation, but it's still a long-term story for us to play.
And Clara, do you agree that we should slowly build up, let's say, the exposure, and then what sectors in that, in China for yourself?
Yeah, I definitely agree that controlling the pandemic is absolutely key, and moving away from COVID zero, I think, is going to be very difficult politically for this year. But we're really seeing quite encouraging developments in how the government is actually making some creative tweaks towards the definition of what COVID zero actually means. So I think recently there's been an announcement that COVID zero is achieved if there's COVID zero within the community. So instead of just focusing on COVID zero stance, right, they are kind of like broadening the definition to include, so if there are no new cases within all of the quarantine facilities, the hospitals, as well as the buildings that are currently in lockdown, that will already enable the government to declare that a particular district or community has achieved COVID zero. So this has really, helped with the reopening that we're seeing in Shanghai, where the local government has already announced that at least 10 out of the 16 districts in Shanghai have achieved this COVID zero within the community. So I think it's an encouraging development in the right direction that will help them still kind of adhere to COVID zero and put the health of the Chinese citizens first, but also not tie their hands at the same time with regards to helping the economy to continue to reopen. And because of these developments in this direction, we are actually quite positive on Chinese equities. And I think overall, the rhetoric coming out from the Chinese authorities have been very incredibly accommodative. And I thought it was particularly helpful that President Xi himself came out to speak about how they're going all out for infrastructure push as well. So we do believe that in due time, as the pandemic is under control, the Chinese government will come out to do more stimulus, both from the fiscal as well as the monetary policy front. And with that regard, I think it's the cyclical sectors that will benefit more in this current environment and the setup.
Thanks, Clara. And I guess zooming in very specifically on China tech. So I'll bring Jun in at this point. You talked about Chinese equities looking attractive, looking at its forward PE ratios and comparing historically, right? So for Chinese tech, do you see something similar as well? Is it looking increasingly attractive for you?
Thanks, JP. So I think with regards to the Chinese tech sector, obviously it has been in a sell-off since end 2020 after the government cracked down on Ant Group's listing, and after that it escalated into a number of things. Alibaba was investigated for its anti-competitive practices. There was a crackdown on the edtech sector, and I think throughout 2021, most of the trading that's been going on in Chinese tech names is mostly sentiment driven. However, I'm starting to see a change in tone from the government between 2021 and today. So in 2021, they talked a lot about common prosperity, equal distribution of wealth, ensuring that consumers are protected. However, in 2020, with COVID zero policy continuing, economic growth is obviously slowing. I think the government is aware of that. And since then, you can see that they have started to mention the word stability more often. And in fact, they haven't really talked about common prosperity or any thing related to the tech sector. And on top of that, I don't think that there has been any major crackdowns on the tech sector for quite some time already. So, and in addition, the government has already mentioned that they want to wrap it up as soon as possible. So I think there's probably light at the end of the tunnel there. And also, the tech sector in China is huge. It employs a lot of people. So by affecting the outlook of these companies, you are also indirectly affecting the likelihood of Chinese consumers. And I think that's something that the Chinese government is very wary of, and they might not want to take things too far. So I think, yeah, probably Chinese tech sector could recover this year or next.
Thanks, Jun. Just now, Wing Guang, you mentioned about Chinese assets that you are slowly accumulating some of your favorite ideas. So if I move to fixed income, which you alluded to just now, so are you worried or do you see some light at the end of the tunnel as well for Chinese high yield, especially the property sector, because that's the sector that has been hit, with default risks are rising and so on, right? So what's your outlook there?
Generally, I'm a bit more sanguine on that. If you look at the supply side, the Chinese government seems very aware of the contingent risk of not holding up the Chinese property sector. So that's why we have been seeing administrative measures, including asking banks to be to loosen their lending to property sectors. And that is a good sign. But ultimately, you also must have demand side kicking in. And right now, many of the Chinese property companies sell their properties through pre-sales activities. And pre-sales activities has come down by almost like 50-60% because people can't go around viewing flats because of a COVID policy. So ultimately goes back to the point that, well, the Chinese government is clearly aware that they want to control the contagion risk in high yield, especially the property sector. That will most probably provide a good backstop to how far lower it can go, how far lower it can drop. But to have a clear rebound, you do need the demand side catalyst to come in, and which is really needing people to start buying properties again, right? And that has to really come with adjustment of the zero COVID policy. If not, you probably won't see a quick rebound in Asia high yield, particularly the properties.
Going back to your catalyst on COVID zero for China, right? So Clara, for fixed income in China, with regard to Chinese property and Chinese high yield sectors for fixed income, right? What's your outlook?
Yeah, so I think Chinese developers have created a lot of problems for Asia high yield market over the last year or so. And with Chinese real estate actually accounting for about 40% of Asia high yield, it is not very surprising that the spreads are trading close to 1,000 basis points for overall Asia high yield, which is 2.5 standard deviations cheap versus the average. And I do think that there's a recovery story to be thought about, from Asia due to the overall reopening, the fiscal and the monetary stimulus that we expect to see out of China, and broadly, more support from the government for the Chinese property sector. That should overall create a more favorable environment for Asian fixed income and Asian high yield in particular. But I do think that credit selection is really, really important here in order to avoid some of the poor outcomes and the most troubled developers in terms of credit metrics. And I think one of the clearest points to how the high yield market in Asia has actually done a very, very good job in kind of segregating where the troubled spots are with the rest of the market is if you look at ex-China real estate, Asia high yield spreads, it's actually just trading at close to 500 basis points, which is much more reasonable and only close to 0.5 standard deviations cheap versus the 10-year average. So I do think that investors, the Chinese regulators are not going to make a significant U-turn in terms of what they've implemented so far in order to enable the property sector to be able to deliver more stable growth and sustainable growth over the longer run on a go-forward basis. But I do think that if investors do want to link back into this space, you have to do so very carefully and probably work with an active manager to select more superior credit.
Yeah, thank you, Clara, on the points shared on Asian high yield and Chinese high yield. I think a number of our investors have exposure there, and obviously it's a sector that's been extremely volatile for the last few months. I'll wrap up with the last discussion point, which is just taking a step back for our portfolio in terms of asset allocation between equities and fixed income. Traditionally, that's how we've been looking at it in iFAST in terms of building a portfolio. Do we overweight equities or fixed income at this point of time? And within equities, then what are the ideas we like? And within fixed income, what do we like or don't like? So I just wanted to wrap up here, and I'll bring all of our panelists into this point. I think Warren Buffett, as you know, has been on a buying spree. He's been buying quite a lot of things. Activision Blizzard is one of the stocks he bought. He was literally on a roll at his recent AGM with Charlie Munger in terms of a lot of the things that he said. So when Buffett buys, doesn't mean we have to buy. I mean, of course, a very different budget size in terms of what we can buy. But maybe more importantly, what should we do? Asset allocation, overweight what, and what are sectors you like? So Wen Kong?
Warren Buffett has a very long time horizon.
Even at his current
yes, correct.
age.
Yeah, he thinks multi-generation. And I think we should all adopt some of that. And there are a few long-term structural trends that is happening. Green transition, elevated, commodity price going to stay elevated. And these are some important structural trends that we can latch on. But in the shorter term, my strategy is really to be nimble. And because I do expect market to be continuing volatile, but because I'm starting from, my portfolio is starting from a point of huge underweight equities and starting to start buying back. I don't think now is the time to sell. But if you do allow yourself to lengthen your time horizon a bit, now is a good time to buy, to start nimbling in according to your own risk appetite. So yes, we should really think in terms of adopt Warren Buffett mentality, think about long term and start building our portfolios if you're not having right now. In terms of asset allocations, I totally agree with what Clara mentioned about the alternatives. And in fact, that is one of the biggest talking points that my clients and I are having. So, and particularly among the alternatives, what looked really interesting to us are really very asset-based type of alternatives. For example, one of the things that we're looking into right now is actually buying the agricultural land. Right. So these are very real, tangible, real asset-based investing, which tick the boxes in terms of being a good inflation protection, in addition to being long equities, especially long, good quality equities with pricing power. Right.
Yeah, which reminds me of what Charlie Munger said: buy farmland better than crypto, right? So, Clara, what are your views on this point?
Yeah, so I do think that staying invested through volatile times is quite a difficult thing to do, just because of our behavioral tendencies. But I think what investors should really note is that success in investing is really achieved through time in the market, and it's not timing the market. So it's quite tempting to try to get out of markets into cash and search for a better entry point during these sell-offs. But more often than not, what we see from historical analysis is that investors actually do miss out on the best days of the recovery, and those that do miss out will see a significant degradation in how their portfolios actually compound over time. So for me, I would actually use this sell-off as an opportunity to, find the high conviction themes that you believe in, right, and these ideas, and actually add to them, because these companies that have really longer term potential are pretty much on sale right now. And for the asset allocation question, I think we've been getting this a lot nowadays from clients that, do we still rely on equity bond allocations? And I think my answer is still yes. But definitely there are times when equity bond correlations do break down. And historically, what we do see is it tends to break down a little bit more when inflation is more dominant in the macro story. But it doesn't mean that there is no diversification benefit to owning equities and bonds. And so what I would really recommend investors is, maybe still stick to equities and bonds, but look outside that by considering things like alternative investments, like I had mentioned earlier, with regards to real estate, for example. The contractual negotiations and the leases typically have some kind of inflation-linked clause that's baked into it, so that can help with your cash flow during inflationary times. And also, on top of that, one of our highest conviction ideas is really Asia ex-Japan equities. And a large part of that is actually a reflection of our conviction in China, as well as the broader reopening and the cyclical recovery that this region as a whole hasn't really gotten the chance to experience versus what has been going on in the developed world. And the sentiment in Chinese equities is already very, very weak. So I think if you think think of risks on a spectrum, I think it is asymmetric to the upside that these markets will tend to do a little better on a go-forward basis versus much more downside from here.
Yeah, thank you, Clara, for the insights. And we'll wrap up with Jun's views on this question.
Thanks, Sripi. So some comments about Warren Buffett first. So first of all, Warren Buffett, he is a professional investor. And like most professional investors, they have better access to information and therefore they can make better informed decisions. But not all of us can be Warren Buffett. So, but one of the things that he advocates is diversification. And I think that's something very relevant and all of us should take note of. And I think my colleagues and our partners later on, they're going to share some of the ETF ideas. And I think ETFs are actually a very good way for you to diversify your investments in the event that you are not very confident in your stock picking skills. So that's one thing. And in terms of the question about my highest conviction idea, it actually has to do with something that Clara brought up just now. So just now, Clara, when she was answering the question on the US, she brought up something on digitalization. So my idea is also related to digitalization, but it's not the internet companies. It's actually the semiconductor companies. So personally, I really like semiconductor companies. I think they really have a place in our world, especially if you think that the world is going to be more tech-driven. Every day we deal with tech. So to take cars, for instance, maybe 50 years ago, there isn't even a semiconductor inside a car. But now with electric vehicles, the silicon content in cars have increased by 60-70%. And I think the long-term story for semiconductors is actually quite simple. And that is if, as the world becomes increasingly digitalized, we will need more semiconductors to actually support all these underlying technologies that we deal with daily, your iPhone, cloud computing, even this mic that I'm using right now. So yeah, I think that would be, to answer the question, semiconductors would be my favorite investment idea right now. Yeah.
Thanks, Jun. So thank you to Clara, Wing Guang, and Jun. I hope the audience has enjoyed the insights. And with that, we have come to the end of the panel discussion. Happy to catch some of you and later on for face-to-face discussions, something we've missed for 2.5 years. Thank you once again. Bye-bye.